Hello and welcome to this very special show on ET Now. Over the next couple of minutes, we would be discussing, debating and ideating that what is the real right way to understand the relevance, the importance and the correct way to value some of the new tech companies. While they may have started as startups, today the relevance of some of these technology companies cannot be undermined simply because of the way how technology now seems to be the enabling factor for just about everything which is there in our life. To understand that and to discuss that, it gives me great pleasure to bring on board Devina Mehra, Nikhil Kamath and Karan Mohla. Gentlemen and the lady, welcome to the show. Thank you for joining us. It's ladies first always on ET Now, so I'm going to start with Devina. Devina, you've seen many cycles, the boom and the bust of TMT, the rise and the fall of infra, and now startup which have become the new tech companies. What is your understanding of this entire new tech cycle? Is this fad, mania, or an indication of what lies ahead?
Hi, Nikunj. Okay, yeah, you are right that one has seen too many cycles, and sometimes I wonder whether having too long a memory is a positive or a negative. In fact, very recently I was reading about this IPO frenzy on the Paris bourse back in 1881. So IPO frenzies are not quite a very recent phenomena, and that this was, it said, like, even shortened prospectuses used to be handed out along with food and at food stalls and so on. So this new listings catching the fancy of people is a very old phenomenon. And in India also you have seen, and obviously everybody remembers the Reliance Power, which was such a hot IPO and that went bust. But even others like DLF was a hot IPO. It listed and doubled from the IPO price for the next few months, and since then has not even seen the IPO price again. On the other hand, Infosys was an undersubscribed IPO, which not many people would remember. So what I would like to first tell your viewers is that whatever is the frenzy in a particular IPO or even just after that IPO list is not often a very good indication of the long-term prospects of the company. So, they must always keep that in mind. And coming back to your question of this new age tech, first of all, I mean, many of them are not really tech companies. They are just using a digital platform to access customers, which is a very different thing from saying that their core competence is technology, which it is not. So therefore, entry barriers often are not, I mean, almost always, why I should say often, it's almost always not that is not the barrier. Mostly the barrier is how much money can you spend to get to the customers. So whoever has deep pockets, that is one very big part of the story. And where actually the companies going for IPO are on a negative footing, because most of them, if you see leading up to the IPO, whether it is Paytm, whether it is Zomato or even Policy Bazaar, they all cut back on promotional expenses to show slightly better numbers, which usually means a reduction in losses, not really a profit in the first place. But now that you are in the public markets, you want to show some improvement there, whereas you may be competing already or may compete in the future with others who have still access to practically bottomless pockets of the VCs. So that puts you at a disadvantage. So, the tech is a misnomer in some senses. I would call them, consumer tech companies, or most of them would be D2C companies, which is, directly selling to consumers rather than a real technology company.
Nikhil Kamath, Zero Dha is an extraordinary franchise. You've changed the rules of the broking industry. You've done to the broking industry what perhaps Jio did to the telecom industry. I'm sure you take a lot of pride in that. But somewhere do you think we need to understand that where the future of the tech companies is headed. Acquiring customer and growing is very easy, but remaining relevant for the shareholders in terms of profitability will be the biggest challenge for the new tech companies, because they can be relevant for the customer, but they not be relevant for investors.
Yeah, Nikunj, I think you've made a mistake here by calling three very pessimistic people to talk about tech on a day when, there's plenty of pain already on the street, with Paytm and everything. I haven't heard from Karan yet, but I think I echo Devina's sentiment quite a bit. I am circumspect about valuations today. A lot of people are pricing in the future like the future has already happened. To make an assumption that, the GDP per capita will go from 2,000 to 4,000, 5,000, the economy will grow at a certain pace over the next 10 years. If one were to make that assumption, then sure, discretionary spending power goes up. The money being spent on companies like Nykaa and many of the peers who are coming online right now, that probably goes up too. But to value these companies like the assumption of the future has already occurred might be a bit of a stretch, in my opinion. So I'm fairly bearish about prospects of companies with ridiculous valuations today. Not just in the listed space, but also in the unlisted space. You hear about one new unicorn being formed every week and all these new companies coming in. The one big thing that has changed between now and maybe 5 years ago or 10 years ago is the access to foreign capital, the access to VC money has gone up tremendously. And I think that is cueing market fundamentals and leading to the rise of very many companies which are valued at a very high premium to what they were historically. Not for a second am I saying, these companies are not great, they're not doing innovative stuff, they are not required. They all are. They have definitely a use case in the ecosystem. What I do not agree with is the valuation multiples that one can attribute to them today.
Karan, Nikhil Kamath has already branded you in terms of you're cautious on tech. So let me first hear your views and let's understand this debate, that what is the right value for these business. I completely agree with Devin. I completely agree with Nikhil when he say that these are great companies, but valuations are stretched. So what is the right value? Right now, it's like saying that you are pricing not gold, but silver at the price of diamond. What is the right price for these companies in terms of valuations?
So let me start off by saying, I think Nikhil is right. I unfortunately though have to be optimistic at all times, right? That's the nature of our business. But actually, and I'm like of the three people here, like the least qualified to talk about public markets. But I think there's two factors at play, right? One is the point that Nikhil made about the companies, all of these companies and the ones that are going public in the coming months and years are required, are very much in the mainstream of things, not a nice niche that used to be there. And I think that's been the one change over the last 2-3 years. What I think is also important to remember is maybe over the last, so I've been doing this for 11 years now, but I know the one question that's always come up is, when are you going to have the big IPOs? And the answer to that has always been, wait for it and look at the demand that will come. But I can tell you, nobody thought 2 years back that this sort of demand will be, precipitated. It's largely also because of two other things. One is just the amount of sheer liquidity in the markets that are there, and also the tailwinds that India is getting from, the net of China effect. So I think all those things have to be taken in place. My own guess, by the way, is that had some of these events not happened in the last couple of years, I think the interest and the way some of these companies have run up in terms of public market valuation possibly could have been there, but at a much lower valuation, right? Because it is inflated because of that. But I think the interest in the market, both from institutional and from what I understand and retail investors, is very much there. But clearly, I think we all have to be very careful. And as a private market investor, I can tell you, I think we all have to be very careful in terms of where we're coming in, how we're pricing it. And if you're priced 2 to 3 years out, then you have to meet those expectations quarter in, quarter out as a public market company. As a private company, you can afford to have a few slip ups, and that it's going to have an impact in the very short term. But to one point Devina made, unfortunately, VCs don't have bottomless pockets, neither do private equity guys. So I think that discipline is you're starting to see that already. Ultimately, a lot of it comes down to just supply demand economics. It's really that simple. I've started my career when the dot-com boom was just about happening, and I've seen what's happened obviously since then. So I think that's the point of caution that needs to be told. And I think that's how some of the public market stocks need to be at least looked at, and the ones that are going public over the next couple of quarters at least.
Devina, that's a very interesting point. Now, between the 4 companies which have gone public, we have a combined market cap of about $50 billion. That's a sizable market cap. These valuations currently are commanding valuations based on where they were in terms of the private market. They've become public now. Public, the minute you go public means quarterly numbers, analyst call, more scrutiny, television commentators like Nikunj Dalmia will comment on you on a daily basis. That's more scrutiny. So what happens to the price discovery in the public market for the startup space now?
Oh, one thing, of course, Nikunj, you are saying that they are priced based on where they were on the private market. That is actually not true, because most of them, even if they have raised money as recently as 3 months or 6 months or 8 months ago, they are going at a multiple of that number, whether it is Nykaa or Policy Bazaar or all of them. So it is not even what the private equity guys or the VCs who had spent a lot of time on them had actually come up as a valuation. Nothing fundamentally would likely have changed in 3 months or 6 months or 8 months. But now the public markets are expected to, and maybe are willing to pay a big multiple to that. So that's the word of caution right there. And any time in history when you start to look at that, what is the new valuation measure I should use? That becomes again a red flag. Karan mentioned the dot-com boom. I mean, at that time it was eyeballs, that you don't need to look at profits, you don't need to look at even revenues. As long as you are getting the eyeballs, it's a multiple of that. So there are every time there is this kind of appetite for any kind of paper, then there is always a logic that is made up. And also these companies have to not just execute on a 1 to 3 year basis, they would have to execute on a 15-20 year basis to justify these valuations. So it is there, as one word of caution which I said earlier is that scrutiny is more. So even going into the IPO, typically they tend to cut down on marketing spend. So thereafter also there is that treadmill of quarterly results, as you just mentioned, and which means that there is pressure to be managed differently from how they were managed as a private company. And it is not just about existing competition. If the niche, which was started out as a niche, has been proven to be enough of an opportunity, you will see more people coming in. And you will see maybe some existing players getting into that area. And one, since we seem to be listing out all words of caution, the international experience in such companies post-listing has not been great, whether it was Uber, whether it was Lyft, whether it was DoorDash and all. Nothing has done extremely well post-IPO on listing, for not just on listing, on the listing day. I'm talking more since then over the next few months or years. So I would say that if you are an investor, this is separate from exactly what you asked, but if you are an investor, too much of, I think, people's mind share, if not their portfolio share, is going into focusing on this one area. Whereas I would advise retail investors that, don't think it's like buying a lottery ticket, which seems to be the mindset at times, that I invest in this process and I'll make something out of it for sure. So look at your portfolio, and now even at lower entry points, you have good services which can advise you on making a basket for you and so on. So look at those things, and rather than just focusing too much on this IPO, which at the moment looks like a gold mine, at least till today. And so, I mean, look at things, step back a bit, and don't get into that mindset. I always remember Richard Branson's quote.
Right. Yeah, that's a lovely quote, isn't it? Okay, Nikhil, you've been a trader, you are an entrepreneur, and you are also an investor. What, to your mind, is the right way to understand valuations of some of the new tech companies? Because Nikhil, these businesses would be there. I mean, Zerodha as a franchise is here to stay. Since you've been a trader in the past, you're an entrepreneur, you understand market, and you also have small investments and seed investments in other startups. You understand the whole way of valuing some of these companies. What is the right way to value them? Get obsessed with cash flows and profits, or is there other matrix which we need to understand?
Well, Nikunj, I'll be a bit candid here. There are many ways to value companies, but the way in which companies are valued today and probably have been valued historically at most times is sentiment, right? If I have Elon Musk buying something, 10 other people are buying it. Based on that, 100 other people are buying it. Influencers like that exist, not just in America, in India, we have our own. So most often you are driven by mass sentiment, and the psychology of things is why a retail guy, applies for an IPO or buys something. If you were to ask me how many people I think are actually researching these IPOs that they're applying for versus how many are, listening to some friend in their own peer group who they think is smart, I would bet on the latter being significantly more important. So valuations are driven by sentiment. Like Devina was saying, everything in life is cyclical. As are stock markets. This crazy euphoria will not last like it has not lasted at many times in the past. There will be a cycle of corrections and then maybe we have euphoria again. But the one thing people have to pay heed to is to make sure they don't buy too much and diversify a lot more than they're doing right now when euphoria is at the level that it is today. When you talk specifically about the IPOs of today, another thing that really worries me is a lot of this is OFS and promoters and smart money exiting to retail money. I think a majority of the money that has come in through the IPOs in the last 1 year has been towards smart money exiting and not really towards companies raising capital to increase their capex and grow their business. So one has to wonder if, the promoters and the early investors and backers of a company are exiting, what really has changed and why is retail running behind it in the manner that they are. Also, there isn't really a very big moat for all of these businesses. Sure, they are first movers in their own industry. They've done spectacularly well. I am a big fan and user of many of these companies myself. All the critique I might have passed on Nike or something like that, I found myself online 2 days ago, buying soap or shampoo on Nike. It is genuinely the most convenient way to buy a product today. They ship quickly, great service. So the need for these businesses, I don't think can be questioned. I go back to the initial point I made about valuation, and I feel valuation driven by psychology and driven by mass hysteria in a manner today has run up ahead of how much fundamentally these companies should be valued at. That does not mean I'm asking you to look at the profit number and value it. I think it deserves a premium to the profit number based on the 80-90% growth rate and the scope and potential in the sector. But I think you have to find a middle ground between that and the ridiculous valuations we are seeing in the market today. Where that middle ground is, I do not know, but I think it's lower than where we sit today.
Karan, I'd like to draw your attention to, let's say, within the startup space, the fintech space. Paytm listing today, Policy Bazaar listing earlier this week. Now, this is one space where we know that change, technology and regulation, the law of the land would change. With Zomato and with Nykaa Bazaar, we can talk about consumer is getting a different proposition, a habit is changing, old habit is becoming a new habit which is more convenient. But with tech, there are old players who are becoming startups, and there are startups who are trying to become NBFCs. What I'm trying to understand, Karan, is that there are startups who are trying to become NBFCs and the NBFCs who are trying to become startups or fintech. Where will it settle?
Yeah, no, that's a good question. And if you look at fintech, right, I think what has clearly changed over the last 4 or 5 years, obviously post UPI, is how much of it has become digitized, both for end users as well as for businesses. And compared to most markets, I think fintech would probably have the largest potential just because of the sheer nature. At the end of the day, almost any company will have some links to payments or receivables. So I think the scope there is a lot more, A, and B, it's a lot much more fragmented and less digitized from many respects, right? So yes, that's probably why you see companies that are startups that are going for NBFCs and the other way around, because that market opportunity is that much there. And unlike most consumer-focused businesses, even a duopoly will not have significant market share. And when I say significant, I mean 30, 40, 50%. So that's where you see a lot of this activity. And ultimately, whether it's a B2B fintech business or a B2C, one should expect that to happen. And the moats around that, once regulation settles in, especially, I think become a lot more dominant, right? To the point Nikhil was making, yes, for consumer businesses, the moat is really around the network effect. For a fintech business, it's a lot to do with just how inbuilt you are to some of those companies as customers. So I would expect that to continue to happen. Just one point, right, on something Nikhil said, which I understand why there is caution, why there is questions that come up around the OFS. And partly of it, I think partly is that, investors like us have timed fund lives, right? We also need to show exits and do that. So a lot of it is based on that. But yeah, I think if you're seeing companies which are only doing 100% or very, very large percent of OFS, I think then you need to stop and think about what's actually being done over there. And I think that has happened in the past as well. Right? We've seen that turn out not so good. But ultimately, not all smart. I'd wager that not all smart money exits at the time of IPO, but you're wanting to cover some of your investment costs because you've been there for anywhere between 3 to 10 years, right? In the case of Paytm, I know some of their early investors have been there for longer than 10 years. So I think it's a mix, as Nikhil rightly said. And I think that mix is the part that everyone needs to understand. And I think he and Nitin put out a post yesterday, which I thought was very, very relevant in terms of how you should think about this and how you should allocate money to IPOs, where it should be a part of your overall basket, but don't over-index. And think about how you should look at some of these companies. I think that's what gets missed out in euphoric times such as this.
Devina, a slightly different dimension here, which is that we tend to look at markets, and when you're investing in public markets for 2 to 3 years, 12 to 18 months, once you extend the timeline for a Paytm or a Zomato or perhaps even Nykaa, the numbers will look very different. Growth will be there, profitability will be much higher. Do you think the best way to look at these businesses is that, look, you're buying them in a different cycle, but you need to be patient for 3 to 5 years minimum before you will get market beating returns, because the markets are pricing in 3-5 years of growth? Is extending the timeline a different way of looking at them, Devina?
Whenever you extend the timeline, Nikhil, you are increasing the uncertainty, and these are new companies. I'm talking even about companies with a long history. Some years back, we did this exercise of all BSE listed companies and said that let us see whether they have shown any profit growth every year. So just that profit growth was greater than zero in every single year for 20 years. And out of those thousands of companies, we came up with a list, I think, of somewhere around 25 companies who had met even that minimal test. Whereas when, as analysts, people are punching in the numbers for and doing a forecast, whether it is for cash flows or profits, it is like growth every year is a given. No, growth every year is, even at any growth, is not a given. And then if you look at these businesses, as Nitin also mentioned, that in many businesses, the moats are not that high. So once you have a proven model, you will also have, besides the players you already have coming in, you look at Paytm, for instance, Paytm, you look at not just the market share, but even its market leadership position, where it is on the league tables, and you will see it dropping every year in the last 4 or 5 years. So about last 4 years or so. So that is the problem, that if it's attractive enough, more people come in. They are also funded. So you don't know what the whole scenario would be like 4 years or 5 years hence. In a very different time. I remember about 20 years ago, Hindustan Lever was getting into atta. And at that time, I had met Amul, and I said, like, what do you think? And they said, we don't think it's an attractive market. But if Levers manages to prove that it is an attractive market, we will get in. What's the big deal? So many times people also wait for a business model to be proven, and then more people jump in. So, दिल को बहलाने को ख्याल अच्छा है कि it will be justified maybe 5 years, 10 years later. Who knows? I mean, and you are already, the point is that even if, let us say, they deliver on all that they have said they will deliver on, isn't that already priced in? That is the second question. That is, if they do all of what they're supposed to do, is probably already in the price, not in every single IPO, but I'm saying broadly as a category. Whereas if they slip up at any time, there is more competition. That then means that you paid too much. So that is the thing. And also it is that whether I often debate this internally, that whether it is a good thing or a bad thing to have earnings. Nykaa has you can calculate a PE, and you can also compare with, let us say, an Alta in the US, which is in a similar business. If you don't have a PE, then you are scrambling around for what innovative valuation parameter to use to justify it. I have seen reports which are saying that this is the PE on 15 years out earnings. I mean, is that even? I have it's good for a laugh, but really, I mean, who knows what the situation will be 15 years from now, especially in a market which itself, you are not talking of something, Hindustan Lever, or you can still say that you have some visibility of 10 years ago. Maybe that also is not clear, but maybe I'm saying that something which has been in existence only for a handful of years, what visibility do you have for 10 years? So, I mean, you are pricing it to perfection, assuming all of that gets executed. That's the point.
Okay, we were doing a show just for the benefit of our viewers. We wanted to showcase companies which have a existence of more than 100 years in India, and trust me, very few companies managed to make the cut. One of them was Tata Steel, which is a commodity company. The other one was Britannia and Dabur. And guess what? Today, Nykaa's valuation is higher than that of Britannia, which has been in existence for more than 100 years. So just last round of questions. I've got exactly 2 minutes. So Devina, maybe a 30-second answer here. I'm not putting a gun to your head, but if I literally put a gun to your head and say that, look, this is out of the startup companies or the new tech companies, if I'm forcing you to buy one for next 5 years, would you buy anyone?
Not really. That is less than 30 seconds. Not at these valuations.
Okay, great. Honest answer, great answer. Okay, great. Less than 30 seconds. Okay, Nikhil, Kamath, last question is coming your way. I'm going to phrase this question very carefully. In your definition, in the current startup world, there is overvaluation, there is euphoria, or there is meltdown. And why am I choosing these words? Because overvaluation will see a correction, they will settle down. Euphoria will see a crash and it will get over. But if there is a mania, then we will see a meltdown.
Yeah, tough to answer this question in 30 seconds, but I would lean more towards euphoria and mania than the former, whatever your first option was?
Well, just a coincidence that today Paytm is listed and we are talking about startup valuations. But yeah, our job is to bring views out. The panel here, fortunately, unfortunately, believes that in the startup space, you got to watch your steps. Investing is about buying gold at the price of silver, not valuing silver at the price of diamond. Thank you all very much for joining us on this show, and thank you for enlightening our viewers with your thoughts. You've been very candid and very